This week, the stock market surged to a record high. After those better-than-expected inflation numbers, it seemed to confirm that interest rates have peaked. Well, many fund managers say the economy has now entered a Goldilocks period with resilient growth, falling inflation, plus the chance of at least several rate cuts this year. Now, for the stock market, the next month presents another challenge. For most companies, it's the half-yearly profit reporting season. Ed Boyd hit the road this week to work out which are likely to be hot and which are not.
The Goldilocks economy. It's a term that hasn't been used for years. You remember, not too hot, not too cold. Right now, the judgment is the economy is just right.
It has been a Goldilocks scenario that has been dominating the market of late. So the economy is faring okay and we're expecting rate cuts.
Inflation has dropped to 4.1% through the year to December. The monthly read is even better, 3.7%, edging closer to the Reserve Bank's target band of 2% to 3%.
It has gone from the market expecting a hard landing in terms of economic data, probably 9 months ago, to in this last quarter, we'd say it's really looking at a Goldilocks scenario where real growth holds up, inflation comes off, and it allows central banks to cut rates without there being a negative impact.
Many economists say the RBA will start cutting interest rates in September. The US Federal Reserve is expected to go much earlier.
The lower inflation certainly helps the prospect of not having higher rates at this point. I mean, we really think the key issue for the market is just how that transition of lower rates occurs. Does it occur with the economy really softening such that you get hard landing in terms of economic data, or do you get quite a soft landing in terms of the GDP growth holding up and consumption? So I think obviously it's actually a good thing in terms of not having further rate hikes in Australia.
The Commonwealth Bank's economists are tipping 6 RBA rate cuts, 3 this year and 3 next year. The cash rate would fall from 4.35% down to 2.85%. The prospect for extra cash in consumers' pockets has got the share market and fund managers looking ahead and feeling upbeat.
Well, the economy is probably going okay, especially the consumer. And so we're now probably at the top end of the interest rate cycle. And so the consumer is definitely slowing down, struggling a bit, cost of living, we've heard, but it's not going to get worse from here, so that's a good sign. In terms of the market, the share market, that's reflected in we're probably running through the slow part of the earnings growth cycle. So over the last 12 months, the calendar year 2023, earnings across the board through different sectors up 3 to 4%, but importantly, analysts from the start to the finish of the year brought earnings down by about 8% in their forecast. So we're in this slower point, and I suspect coming into the next reporting season, you're going to get more of that. We're not through it yet.
Matt Kidman says the tech sector, industrials and discretionary retail will produce the best results.
The tech sector, I think if they can hit their numbers, we'll get support, just like the NASDAQ. We've seen it lead the market again when everyone said, they've had the run, they can't keep leading. Well, it has, and keeps getting expensive. I think industrial companies have got a little bit of leverage. The good thing about having a slowdown is that costs are attacked, especially in industrial companies who've got that high fixed cost base, and if revenue can really play around with their earnings. So industrials in general have probably kept that lid on costs, even though inflation is there. If you get a bit of a revenue kick, that improves. I think energy will be poor because the Woodsides, the Santosses, the beaches, which are important to Australia, because the price of oil and gas have been lower. Now it's may bottom, so the next half might be better. Consumer, all right. The discretionary consumer groups should do okay.
Anna Milne from the Wilson Asset Management Leaders Fund, which focuses on large cap companies, thinks the COVID-induced economic upheavals are now well behind us.
I would say that companies are going to be cautiously optimistic. I think last year was quite different in that we were staring down into this widely anticipated recession that never really came. And so understandably, when it came to outlook commentary, they were more reserved into how much they would really provide the market. Whereas now it does feel like the economy is through the worst of it, so to speak, at least from a rate hike perspective. And so we think there'll be more commentary around the outlook and how things have really traded.
Despite inflation coming down, costs are still rising for all businesses. The ability to keep profit growth going forward depends on any company's ability to raise prices quickly. Some say this is where companies like Wesfarmers, Super Retail Group, Coles and Woolworths will capitalise.
We're looking for companies that are going to have resilient demand profiles through what's a relatively slow environment. And we're looking for companies that have pricing power, because we think the cost inflation that you're seeing for businesses is actually higher than what you're seeing at the CPI level at the moment. Cost of doing business for Australian companies, a lot of them are talking around 7% increase in the coming year, between wage increases, payroll tax increases, superannuation increases, rent and utilities and insurance all rising.
The banking sector has been surprisingly resilient over the past 6 months, defying expectations that higher interest rates would create much larger bad and doubtful debts. The Commonwealth Bank alone has been the biggest influence on the ASX, reaching these all-time highs. But when the banks report record profits this time round, the focus for fund managers will be on their net interest margins, the difference between what they borrow and what they lend at.
The banks have shot the lights out. That surprised me a little bit. The four big banks, they're all trending up towards record highs. They've actually led the market since that recovery in October, late October through. Bit surprising, but you're right. The trigger's been that bond rates have come off, where the inflation fears have eased, and so the banks have led the charge here. Technology in the US and other parts of the world, banks here, which is a great part of our index.
But not all fundies agree that the banks are the ones to watch this February. Some think the property sector has more upside.
We think REITs are looking quite interesting into this reporting season. They are very stable. They have strong dividends and quality portfolios. So we certainly do like REITs into the results. The banks aren't reporting next month, apart from CBA, but they have run very hard from a share price perspective, and we think fundamentally they just don't stack up to the same degree. So we are quite cautious on the banks at the moment. We think credit growth is going to be okay, but certainly not incredible. And while this has been driven more by a less delinquency kind of story, we don't really see a huge amount of upside to the banks at the moment.
But this year, fund managers say geopolitics will take centre stage, having the ability to rapidly affect economies, markets, and global trade routes.
There are a number of dynamics we have to be keeping a close eye on, whether it be Ukraine or Israel, or closer to home, China, Taiwan and the rest, and even the number of general elections that are happening this year. If we have a Trump in power in the US, that's going to change the market dynamics quite significantly.